actually caused the price of XRP to go up. So could we talk about like actual manipulation? The forgery though of a BlackRock's person, like not their signature, but I don't know how that works, but it seems like forgery could be at play here. And I don't know, it just seems like not worth it to me. But I just called BlackRock when I saw that. It was on the site. So I did that first and I was like, could this really be real? It didn't feel real. But then again, I didn't think they'd file for an Ethereum ETF that quickly either, to be honest. So I'm like, well, and it looked exactly like that one, which was from 4 days ago. So there was a lot of patterns that look fine, like, pattern, and then pattern. But then I called BlackRock to check and they were like, no, this is false. And you can say that. So then later that day, I spoke to them again. And then I spoke to them again because I was like, it's still on there. And then I didn't break it, but somebody else broke it. The Delaware, what you call it, Attorney General or the Department of Justice was looking into it. And that's the crapping of the pants quote I gave because.
Welcome to the Rose Show podcast. Thank you so much for joining us. I'm here with Eric Balchunas. He is Bloomberg Senior ETF Analyst, and he's also a great author. He has two amazing books, The Institutional ETF Toolbox and The Bogle Effect. He's also co-host of two amazing podcasts, Trillions and ETF IQ. How you doing over there, Eric? I see you're in the office today.
Yeah, gotta get to the office a certain amount of times these days. So I'm here to fulfill that obligation, but mostly I'm here just banging away on notes, doing a little tweeting, and now talking to you. So great to be with you.
Thank you so much. Great to have you here. You are a brilliant mind in the ETF world. So we want to go into ETFs, but I have to begin with this fake news, crypto ETFs. You are on it. You caught it right away, even though it was on the state of Delaware website. And now it's in the Department of Justice. Is someone crapping their pants?
Somewhere, someone out there has to be. I mean, I was going to use the S word, but because I don't want to get in trouble at work or anything. The real term is someone is S-ing their pants, to be honest with you. And you know that feeling when you're like, oh, this small gag or prank wasn't smart after all. I'm actually in big trouble. I've had that feeling a couple times in high school, getting caught doing random things. And I know the feeling. This is a bigger level, though, because you pissed off BlackRock and the government. And BlackRock, obviously, then you actually caused the price of XRP to go up. So could we talk about like actual manipulation? The forgery, though, of a BlackRock's person, like not their signature, but I don't know how that works, but it seems like forgery could be at play here. And I don't know, it just seems like not worth it to me. But I just called BlackRock when I saw that. It was on the site. So I did that first and I was like, could this really be real? It didn't feel real. But then again, I didn't think they'd file for an Ethereum ETF that quickly either, to be honest. So I'm like, well, and it looked exactly like that one, which was from 4 days ago. So there was a lot of patterns that look fine, like, pattern, and then pattern. But then I called BlackRock to check and they were like, no, this is false. And you can say that. So then later that day, I spoke to them again. And then I spoke to them again because I was like, it's still on there. And then I didn't break it, but somebody else broke it. The Delaware, what you call it, Attorney General or the Department of Justice was looking into it. And that's the crapping of the pants quote I gave because you get the like serious lawyers now. And how hard is it to just trace how somebody typed it up? But I got to say I thought it was pretty obvious. I thought that I'm working at Bloomberg. I have a relationship with BlackRock. If I say that, it's probably true. Amazing the amount of people who could not accept it. I guess they really wanted XRP to stay at this higher level. And part of me and other people saying it's not true caused it to go back down. And I guess that upset people, but I'm just the messenger here. I don't really care. I'm just telling you that this is false. That's what they said. So there was this like whole 24-hour period of people questioning who is this guy? He's lying. BlackRock lied to him. And it was like tinfoil hat land. And somebody goes, oh, well, I see you've met the XRP army. And, when covering all of this, I've interacted with the Bitcoin maxis. I'm getting my feel for the sort of planet of crypto. And I never stepped into the XRP area. And man, it was like, you know, kind of stepping into like a fire ant nest or something. It's just, whoa, they came out of the woodwork and they were pretty brutal, to be honest. It was a real, they were fired up and they just wouldn't accept no for an answer. And BlackRock even tweeted it out today that this is false. And I still had somebody saying, I don't believe them. I it's just, anyway, so it's what a trip. But anyway, mostly my interactions online with the crypto world have been fun, engaging, and energized. This was a little like almost like a, again, it was like a turn into a dark alley, and I got beat up a little bit.
Absolutely. Definitely on
But I'm
Twitter.
okay. I've been on Twitter 15 years. I have thick skin at this point. It's okay. And my
Absolutely.
conscience is clean. I was cleansed. I had no guilt, so it's easier to fend off whack jobs like that when you have nothing to hide.
Well, we appreciate you speaking up and calling that one out. I remember when you did a few days ago, and we're grateful for that. Thank you so much, Eric. Now, you also have spoken about the Bitcoin spot ETF. I know there was, I think, someone they say called it an intern that decided to put out news that there was going to be a Bitcoin approval or something like that. And I think you caught that one too. I think it was a week ago or 2 weeks ago. Could you tell us about that as well?
Yeah, it's weird. I think there's like crypto time and then regular time. I believe that thing was like a month ago. I mean, if we look, yeah, that's how fast things are going. Yeah, so this was a tweet from Cointelegraph saying that a BlackRock ETF had been approved. And obviously that caused a 5% spike in Bitcoin, which was, that's really something. And uh, I had initially said, can this be true? I wasn't totally into it, but I have to deal with this. James and my team said he thought it was fake news. And then I went on the terminal, the Bloomberg terminal, we aggregate news, and I saw Reuters report it, or Benzinga reported it, but quoted Reuters. And I was like, okay. And so I'm like, maybe it's real. And then over the next 30 minutes, I think Fox Business reporter confirmed that it's not real. So then that whole thing happened again. And all this plays out within like 30, 45 minutes. And so this thing with XRP was very parallel to that one too. I don't know who sort of whisper campaign that this was happening. Sounds like somebody heard it from somebody in a chat. And honestly, if you're a journalist, you shouldn't go out that quickly with that. Or if you do, you could say where you heard it. So you could say like someone in a, I don't know, like chat room said this is happening. And of course, most people go, okay, well, I don't really pay attention to this. But when you say source says, and you don't say where the source is, maybe you have a source of BlackRock, that they should have been way more descriptive when putting something that explosive out. And I think they admitted it. They went back and actually documented how it happened, and I give them credit for that. But yeah, bad. All this stuff kind of feeds into the SEC's originals issues with like this area is subject to fraud and manipulation. And I just think if you're in this world, you should be on your best behavior. We're almost at the finish line here. Like, just keep it together. I tell my kids that all the time. Like, we're almost home, or this thing is almost over. Just get 10 more minutes. Come on, just hang in there. When they do things they don't want to do. So anyway, that's what happened there as well.
Feels like just yesterday. You said it right. It's like a time warp. I feel like they're all happening so quickly. So many of them. I think when we finally get it approved, no one's going to believe it. And they're going to be like, that's fake news. Speaking of the Bitcoin spot ETF, you have your finger on the pulse. You're right there in the ETF world. What are your thoughts on a timeline, potential timeline, where you think it could actually be approved?
Here's my general thesis. Again, it could change, but I think in a few weeks, we're just going to wake up one day and hopefully Bloomberg gets the scoop, or CoinDesk, or somebody. Maybe I'll get it. I don't know. And we're going to just find out that the 19B4s are approved. We web scrape, so maybe our web scraper will catch it. And we're going to go, that's it. And the 19B4 is one half of the process. But if those get approved, the moment we learn that, it's a game over, because trading in markets approves the 19B4s, and then the S1s are like the prospectus, and that's approved by a different SEC division. But they all report to the 10th floor, which is where this issue is right now. That's where Gensler sits. So if we see trading and markets approve, we're pretty much home free. There will be some details probably to work out with the S1, maybe some other updates. Some of this stuff could take a while, especially the holidays. So I could see this being pushed into 2024. Now, I could be wrong too, but that's generally how I see this happening. So I see the joy of the good news of approval within weeks, in my opinion. But then there still will be some steps to take before they're actually on the market. And that process could take 6 weeks to 2 months. But once they're trading, that's a whole different thing. And you love to see the actual trading. But the real thing we're waiting for to release all this pent-up energy is this 19B4 approval. And once we get that, all this other stuff will be like really more easygoing details, because we'll know we've crossed the finish line already. And so I think that's how this will play out. And we'll see. So, but they technically have till January 10th to approve the 19B4s, by the way. So they could stretch it out all the way to then. I don't think they do, but like I said, even if they did, we're now talking 7 weeks. So this is it.
This is the
After
final
10 years,
stretch.
yeah, if you're talking about a 10-year saga, this is the final 1% of all this.
Wow. The final countdown.
It is.
Exciting. Thank you so much for your wise and insights on that. Well, let's talk about the markets. Okay, here we are in November. Let's put aside the Bitcoin SPY ETF and let's just talk about the flows that you're seeing. It seems like it's risk on. We have seasonality at play here. November is usually a beautiful month. What are you seeing when you're looking at the flows?
Yeah, it seems to be a barbell approach. People are buying SPY, the S&P 500, and some people equal weighted it. The Qs have taken in a good amount of money this year because equities are up nicely. They're having a good year. But on the flip side, at the same time, a lot of money's gone to the most boring end of the curve, or the investment world, which is money market mutual funds and short-term Treasury ETFs. They used to be a place you'd go just to hide out, and that you usually be bearish. If you saw money going into a money market fund, like in 2020, March, a ton of money went into money market mutual funds. This is just because it was afraid of everything else. The money going in there now is not afraid. It just wants 5% yield. Rates have lifted it, so you can get 5% and no risk. That is pretty compelling for a lot of people. So those funds have grown by $1 trillion. That destroys and trounces all ETFs combined. That's triple the amount of money that ETFs collectively have taken in this year. So that is a monster difference right there. So I think now that you can get 5% with no risk, it's also had to make other things work harder for your money. So earlier in this year, when the markets went up like 15, 20, 30%, nobody bought it because they were in the money market fund saying, I'm fine here. Plus, I don't really buy this rally. I just think it's maybe like a false positive. But it ended up going and going, and finally people came in May. Since then, there's been a little back and forth, but largely most of the flows go to short-term dated Treasury ETFs, money market funds versus equities. And I get it. People want to participate in the equity markets just because they have been better than people thought, but they also love that 5% for doing nothing. So that's sort of the general story of the year. The other, I think, thing to mention is just that I think the Qs in particular, that's the NASDAQ 100 ETF, it's just amazing. On our team, we always joke about how no matter what we write about or what we think looks good or cheap, it might have its like 5 minutes of fame, but then the Qs just come and just demolish everything time and time again. Like International had like a little run, and then bam, the Qs said, no, thank you, that was fun, I'll take over. And even value stocks, value had like a year. It was supposed to be like value's time to shine for like a decade, and the Qs came back and said, no, go back to your value pain. So it's interesting also that even though rates are high, you did find this reversion to that old trade from the last 15 years, which is the Qs and tech. So that was a little of a shocker for a lot of people, in my opinion. And I think that's the sort of environment we're in now.
Yeah, I mean, you can't complain. And the highest we've had rates, and I think what, over 15 years, people are enjoying being able to do nothing and actually get something on your money. Money market funds, T-bills, the short-term ones, I particularly like them myself. And then, if you get fancy, you could use them as collateral, and then you have yield stacking, and those are other strategies there. But, there's so much, it's a different environment that we're in. And so, yeah, makes sense there. Sounds great. So now ETFs. Why ETFs? You and I know why. There's an ETF for everything nowadays.
Yeah.
I think you could do anything with ETFs. Now we have diversification, better risk profiles, low fees. And it's pretty amazing with these active funds nowadays, how low their fees are. So let's break it down for people. What are, why ETFs? Give us the positives and negatives.
Yeah. Look, I was assigned ETFs in 2006 as somebody just working on Bloomberg data, right? I was in charge of making all the data was correct and stuff on the terminal. And when I started to kick the tires on this new structure, I was like, wow, this is like 5 or 6 evolutionary steps beyond the mutual fund. It's like a mutual fund, but with benefits, several benefits. And my big metaphor is I compare it to the MP3. That's sort of how you can digitize music. And the mutual funds are like compact discs. You pay $16 for like 3 good songs. And if I don't know, I might be dating myself, but just spend like
I feel
60
the
bucks
same.
$60 a month on CDs. That's a lot of money each year. Now I spend like $60 a year. And so ETFs, I think, have helped, and Vanguard in particular, have helped slash costs by about a tenth. So you get everything cheaper, and you get it instantly. A mutual fund you can only get in once in a day. ETF you can buy right on exchange, so there's no waiting. And throw in the tax efficiency. They rarely kick out capital gains. People like that. You only pay taxes when you sell, so it's more on you versus what other people do. That solve that. And then in terms of just building a portfolio, they're just so easy to sort of like put your little puzzle pieces in place. So you add all that together and you come up with a very, very strong value proposition. And so they have really disrupted the whole investment vehicle landscape. So right now they make up, I don't know, something around 30% of what mutual funds have. So they're still actually they're in the growth mode still, but they're going to continue to eat market share from a lot of places. And they don't just take it from mutual funds. They also take market share from single stocks. A lot of people might be like, well, I really want to invest in healthcare or biotech, but I don't have time to research which one, and I don't want to pick the wrong one. So I'll just buy the biotech ETF. So I think they've actually pulled some money from single stock investors, mutual fund investors, and even derivatives. Some institutions will use a very liquid ETF instead of a futures contract. There's options on ETFs. You can short ETFs. So they're kind of a Swiss Army knife for different investors who appreciate their certain advantages over others. And it's really a phenomenal product. And what I really like about it is it's democratized in a couple ways. A, it's made everything come to your doorstep. Click a button and you own almost anything you want. But the second thing is you pay one fee. So like take, I don't know, the Vanguard Emerging Markets charges 10 basis points. That used to be the institutional price. So only if you were a rich person and could put like $1 million in a mutual fund did you get the I class. And then if you were like on lower income and you can only afford the $1,000 minimum investment, you went to the A class, and that probably charged 4 times as much as the I class. So it was like a regressive tax. So these share classes in mutual funds really punished the lower portion of investors who weren't institutions. ETFs gives everybody the I class. So it just demolishes that whole concept. So Bridgewater, which is the biggest hedge fund on planet Earth, Ray Dalio, they own VWO, and so does my mother, and they pay the same fee. That's really cool, and that's never happened. Up until now, if you had a bunch of money, you did not mingle with the plebs, so to speak. But ETFs bring everybody together.
Agree. They use that. I like the hedge fund ETFs, the long short strategies, the managed futures, multi-asset, trend following. There's just so many, and we're going to break it down. We're going to go into all of them. So, but I think the first thing we should do is the first classification is passive versus active. And I have to say, I was just reading up on this, how 2023 had even more active ETFs come to market than 2021. I believe the number was, as of November 1st, 309. And what I've noticed is these actively traded ETFs also have the lowest fees. How is that possible? That's like amazing.
You mean the active ETFs have low fees?
Yeah, I'm
Yeah.
surprised, like
So,
how low.
my last book was on this topic called The Bogle Effect,
Yes.
and Vanguard deserves a lot of credit for the ETFs. Even though Jack Bogle wasn't a fan of ETFs, he didn't like that they traded a lot. He thought they might tempt you to trade too much. But ETFs, when they launched, they matched the fee of the Vanguard Index Mutual Fund. So Vanguard brought fees down. They deserve credit for that. ETFs just sort of piggybacked off of those low fees, and they brought everything together, the Vanguard effect and trading like a stock, all in one little package. So, but it's the Vanguard effect why active is getting cheaper, and they have to. You know, if you're losing customers and you're a store, you have to do something. You either have to get the new, greatest, innovative stuff to attract people, or lower your fees. And in a lot of cases, these funds don't really have much new to offer, so they're just like, we have to slash our fees. So this to me is just the reaction to losing so many customers. They have to do something if they want to sort of survive into the future. And so if you look at the asset weighted average fee of an ETF, it's now down to 17 basis points. But you can still get some that are below, 10, 5. Active now, most of the flows go to stuff below 40 basis points. So really, investors are driving this. If you look at charts and you put flows into active ETFs into buckets, 95% of the flows go to the active funds below 40 basis points. So any active management company is looking at this, and then they may decide to ignore it. They may be like, this hurts too much. I don't want to cannibalize my business. I'll just like keep my high prices. Or they can go, look, the writing's on the wall. Like, this is what the people want. And many of them have just sort of surrendered. Capital Group, DFA, and now like a lot of their stuff's below 40, even 20. DFA has one active fund below 10. We're going to continue to see this gravity pull these fees down. So a lot of times I remind people that this big trend we're seeing, the best way to put it is called the great cost migration. It's not necessarily active to passive or mutual fund to ETF or broker to advisor. A lot of what all this represents is just high cost to low cost. And so it makes sense that active would have to get to the program, because smart beta ETFs, which are like indexes that they tweak to make them more active-ish, those didn't have flows until they got cheap. ESG didn't have flows till it got cheap. It's a pattern. Once you get cheap and below 40, 20 basis points, good things start to happen. People start to look at your fund. And I think in the case of active, like there's also this idea of how active are they? A lot of them hold a lot of the same stocks you can get in an index fund, Apple, Google, et cetera. So you only should charge them for the active, not the beta, so to speak. You have to beta adjust your fee. On the flip side, though, there is this other lane opening up, which I call hot sauce. So if you go absolutely wild, like Kathy Wood, and you have a portfolio that only has 1% overlap with the S&P, like you're very different, you can charge more. You're very volatile, and you offer potential for returns that have nothing to do with your index funds. So whether it's Kathy or thematic investing or leverage ETFs, I think people have a small slice of the portfolio to go absolutely wild with. And I think that's where, again, I call it the hot sauce lane. Active is finding a home there too. And you can charge more there. That's why a lot of the product that comes out in the ETF world is not, boring, like plain vanilla beta, because that's already been had. Like Vanguard and BlackRock, they already charge 2 basis points and they have all the assets. It's more crazy stuff like single stock ETFs, endless themes, all this kind of very innovative, creative, volatile stuff, because they're trying to create stuff that can complement your otherwise boring core. So in short, if you're active or passive, you kind of have to be cheap or shiny. You have two roads pretty much to get organic flows in the future.
Interesting. So I'm going to put, being an entrepreneur, I'm going to look at it from the business side. And we know in many industries, you have the big, like the Amazon come in and it's knocking out a lot of the smaller ones, like the mom and pop shops and the smaller businesses, because they're able to streamline and smooth out their revenues and costs, and they're able to maintain those lower fees. and move forward, while other smaller ones aren't. So because of this great cost migration that you're talking about, are we going to see a continued evolution? And is it going to be the Vanguards, the Black Rocks, the larger dimensional? These larger ones are going to take up more of the market share, while the smaller ETFs, maybe the more boutique ones, maybe won't have as much of a place?
Great question. In the end, I see this whole industry moving to like a way that other industries are, like the airlines. There's three big carriers that have 75% market share of all airline traffic. I think it's American, Delta, who am I missing? United. And then you've got Hawaiian Air, you've got Alaska Air, you've got people who do private jets. There's always going to be room for specialty niche, alternative kind of services. I think over the years, we're going to see a lot of consolidation. You might see a T. Rowe Price and a State Street merge, and then a DFA and this company. BlackRock could acquire a couple people. And you might be looking at like Vanguard, BlackRock plus 5 firms, State Street plus 5 firms. And right there, you've got 70% of all the assets in America. And they compete on fees. And every now and then when something gets hot, they'll like me too it and do it cheaper. But the innovation is really going to be driven by the other independent issuers. We've seen time and time again that a lot of if a new category is busted open, like the buffer ETFs, which are target outcome ETFs, that was driven by a startup. ARC is a startup. Like these, I call it the indie world, independent issuers who are not connected to the big guys. Innovation's just a lot. They're just like little speedboats. They can move quicker. The big guys are like aircraft carriers. They can't turn or move easily. Everything has got to go through like 20 checkpoints. But they can acquire people, that's for sure. So they'll just keep acquiring, but the innovation will happen, and there'll always be room for the small person who is, innovating. And I think we've seen that. So I think you'll see, again, 25% of the market will be for these smaller, innovative indie shops. Like I said, it's a hard industry, but anybody can make it.
Fascinating. Interesting. It's very similar to other businesses and industries in that there's always room for that unique product, that differentiated product. And then as that grows, and they can be acquired by some of the larger companies, and then there's consolidation. Interesting stuff. I love it. Now you mentioned theme, and I find that very fascinating. There's a lot of that ETFs with theme based, and they some of them do the more traditional, do airlines and so forth. Then they go theme and EV, or they do real future, the future categories, and they go into that. Are you seeing an increase in that? Are those growing in popularity, and how have those been doing lately?
You mean like ETFs? They're called like the future, like innovation, disruptive tech.
Like AI and
Yeah.
quantum computing.
Yep. Yeah. So I think themes are chameleons. They can wrap up anything. They generally, though, wrap up growth and tech, because that's where a lot of the bleeding edge stuff. And the old sectors like tech, communications, they're very much stuck in time, and their legacy. And it took, I think it was S&P, like 10 years to add real estate. I mean, they're like aircraft carriers of the index sector world. Themes move at warp speed. I remember like 3 years ago, there was a trade war. Remember that trade war thing?
Yes.
It was like between us. It was like they put a trade war ETF out like within like a month of that whole news cycle. So we're going to see theme ETFs really steal the thunder of the sectors and capture fast-moving narratives. So they'll generally lean tech and growth, and those have done okay this year because it's come back, but they got crushed in 2022. But on the flip side, a theme that did really well in 2022 is natural resources, which is a lot of like oil and materials companies, a lot of value stocks. And so a theme, in my opinion, also wraps up value and growth in more fun, clever ways. So like if value has a comeback, there are themes that track value stocks. Natural resources is a great example. But most of the themes tend to be a little more growthy and a little more tech oriented. I think they excite the mind more. They excite your FOMO. But they can be anything. Again, themes are chameleons, and they can wrap up any single narrative they want. And so we're very bullish on themes, and they also, again, can complement a cheap Vanguard index fund rather than compete with it, because most of them have almost no overlap with the S&P 500 or the total market. And so as they have a viable lane, to me, they're a new form of active that has potential.
They're very exciting. I have to say, it's like a long-term investment strategy that gives you exposure to these disruptive industries that they're carving out. They're like molding future categories. I find that fascinating. So I also am very intrigued by that. Are there any in particular that you're watching or that you prefer, like?
Yeah, one of the ones that I've been watching for 4 years, I feel like I was early on this too, is uranium miners,
Oh, yes.
and that's what we call the nuclear theme.
Mm-hmm.
You know, any logical person could quickly come to the conclusion that in order to get anywhere near net zero, you're going to need more than solar and wind, because the sun isn't always out and the wind doesn't always blow. Nuclear isn't ideal, but again, if if you have these conflicting wants of you want net zero, but you still want to move around and heat your house, something's got to give. And to me, nuclear is slowly coming around, and uranium miners will be needed for that. And that has had a great run. So to me, I call that green investing for realists. And so that's an example of a theme. And you're not getting any of that in basic Vanguard index funds. And so that's also we don't score funds, but we have this intensity ranking, and we will give a higher rank if it's different than the index. And uranium ranks high because these stocks are not really in the broad indexes. Because if you're going to buy a fund outside of your core, you want it to have something you don't already own, right? And so that's a good example, of a theme that has a good narrative attached. The performance is amazing. Again, it can go down. I'm just saying it has had a good 4-year run. And it's completely differentiated from the rest of their portfolio.
Well said. I got a little excited when you said that because I always talk about URA and
Oh, you do?
CCJ. Absolutely. I love that that
It's interesting
ETF.
though, in due diligence for ETFs, URA is sort of like that's the Global X one. Yeah, that's pretty concentrated too. You're right. URNM is a little more concentrated, and then URNNJ, which is like hot tamale, that's junior uranium miners.
Mm-hmm.
So if you're picking out a theme ETF, we really tell people to look at the standard deviation, and then look at the standard deviation of the S&P. The S&P, I believe, might be something like 18%. URA is probably like 30. URNM is probably like 40. URNJ is probably like 65.
Mm-hmm.
And that's like telling you how bumpy the ride's going to be. And it's a good way to fit like how comfortable am I with volatility going into this theme. The good news is these ETF makers usually have several options. And there's even one called NLR, which is the VanEck Nuclear. And that's sort of like the nuclear economy. So as utilities, that one's going to have a standard deviation more like, I don't know, 30. Like that's the most basic. But when uranium pops, they're going to pop in proportion to how concentrated and volatile they are. So, but if they pop down, like I said, it's a double-edged sword when you go with these really highly volatile names. But I think if someone has the core of their portfolio covered with all of the serious investor stocks and beta, as we call it,
Mm-hmm.
you want wild and crazy in your theme. You want something very pure and aggressive, and you can stomach that volatility because it usually is a small allocation, and you've got the fundamentally sound stuff covered. So you're not going to freak out, because investing in a theme such as uranium miners takes a strong stomach. But that stomach is made, it's a lot easier to stomach it, again, when you've got this sort of core covered for like almost no fee. And I give Vanguard credit for providing that nice environment, because what has really hurt investors in the past, and some still do it, is performance chasing in thematic ETFs. So I would say find something you really are into with your heart and soul, and then you got to hang in there for a while, because they're going to have good year. They're going to either be like towards the top of the performers that year or the bottom. And you don't want to buy up here and sell down there. That does nobody any good.
Well said. I absolutely agree. You need to balance a portfolio, and if you have that as a portion, it's part of the asset allocation. And I always say, volatility is not risk, and but it's about being able to stomach that wide standard deviation there, which is even wider with the junior miners. But I think there could be a place for that depending on people's tolerance of that. I love it. You gave us so many great ones over there. Uranium is definitely one to watch, in my opinion. In this higher for longer environment that we're in, not necessarily much higher, but this new regime, I think we're going to be probably at higher rates because we do have embedded inflation. We want cash. We want real assets. So free cash flow yield is important to many of us. And I know there's a set of ETFs there, CAF. I think they're the cash cows, they're called. I know you're very familiar with them. Cows. What are your thoughts on all those? I know they had a lot of assets that flew into them, that flowed in, and but I don't know about their profits per se. What are your thoughts on that whole free cash flow ETFs?
Yeah, look, in the rate hiking cycle of the past 2 years, they've crushed it. They own a lot of energy stocks. So just know that in some of these, you got to look at the sectors. You're definitely getting a lot of energy, and they're definitely a value tilt. I mean, the PE on cows is 9.6. That's what, like, the S&P is what, 20 something, 24, somewhere in there. So these are beat up stocks, but value had a nice run. So value coming back really helped cows. But also, when rates are high, people want companies that have cash because you got to pay interest rates that are higher now. So that's why high growth sells off. So it was came out 7 years ago, but its moment didn't come until the rates came up. So it's a great example of like how you have to hang in there if you're an ETF issuer, because you never know when the sun's going to shine on your area. And certainly cows was a huge hit. I think at this point, I can tell you right now, it's I think 20 billion, the 16 billion, and then CAF is like 4. So the two of them are 20 together. That's a monster size hit for a small issuer. Again, it's like when a movie from Sundance makes it into the regular theaters and becomes a big hit, like Napoleon Dynamite or something. This is the equivalent of that. It's rare, the feel good indie hit of the year. This is that right there. So they now have, I think, 10. If somebody has a hit, they quickly jam out the sequels. It's like movies. So they have cows, calf, then they've got like global cows, G-cow, like they've got a whole family now of these cash cow ETFs. Cows and calf have much of the assets, but still, the other ones have a couple hundred million. So yeah, they stepped in it, man. This is a good product for them. What do I think of it? I think if you add a little of this, it kind of gives your portfolio a little extra value and a little extra leaning towards cash flow. And I think in a rising rate environment, I could see the need to do that. Like I could see so I think I would use this to tilt. I wouldn't sell my Vanguard and buy this, but I could see you could use this to tilt over to these sort of more cash flowing companies.
Absolutely. Well said there. I just thought that was fascinating to find a group of them like that that's focused on the free cash flows. Having cash is important. We want, short duration assets. We want ones that aren't as sensitive to that risk-free rate, which is much higher than it's been in quite some time. And so higher cost of money, debt we have a re-rate of risk. So cash generators are great. So let's talk about these larger ETFs that are in the small cap sector. There's a lot of them, and they raked in a lot of assets this past year. I know there's VB, I think AVUV, IJR. What are your thoughts on all that? The Mag 7 had a great run, is doing great. We want highly liquid. We want these stellar companies, mega caps. Do you think that they may have a run next year? Or do you think we can have that rotation? Or could some of those be the next ones to fail?
This is a question we debate on my team all the time. How much more can the Qs and these Super 7 stocks just run over everything? They've been doing it for 15 years. I don't know is the answer. A lot of money this year went into equal weighting and mid caps, as you said. and even some small caps because they thought, I want equity exposure, but these Super 7 are just, the valuations are too high. But do they still seem to go up? We recently talked to somebody who looked at intangible value, and he said people underestimate the brand value of some of these companies. So the stuff you can't measure on the balance sheet, if you really value that, some of these valuations go down a little because these are unmeasured things like the sort of brand that an Amazon has or an Apple. And if you kind of look at it that way, I think you can kind of chill a little more with like keeping, buying these more and more. But they've done studies like Nvidia at the price to earnings ratio it is. I believe somebody went back over 100 years and looked at stocks that were trading at that high of a PE and what their return went on to do over the next 5 years. And almost all of them like maybe had a couple 6 months but went down. Like they were able to sustain that valuation. There was one exception, that's Apple. So out of 100 years, there was like one exception to a company that was able to go at Nvidia's PE and go up from there. But again, the 100 years of data doesn't include the internet and tech. And does the brand value and the low overhead of tech give these stocks extra something that's new that was not measurable in the past? I don't know. There's some people making that case. The other thing is if you took companies like Apple, Google, Microsoft, and you unbundled the companies they own, like Google owns YouTube. And I just got YouTube TV, and like YouTube could be a blue chip company on its own. And you forget that's under Google. So there's a lot of juggernaut stocks within the one. So if you take the Super 7, it's really like the Super 30 because there's all these like, LinkedIn is under Microsoft, Instagram, Facebook. They own all of these other companies that could be their own stocks. So it's the Super 7 isn't just, oh, these are great companies. They're actually like multi companies inside one company.
Well
So
said.
that's why personally, again, this brings us back to why indexing is very powerful. If you buy the total market or even, the S&P 500 ETF, you largely can avoid thinking about some of this because you're just going to own like all of those names anyway. But certainly when you want to tilt or rebalance, these questions are important.
Well said. Yeah, these larger mega caps are like indexes themselves almost. They say like Tesla's like an index, and like you said, Google. Very, very good points there. I want to talk about your beta adjusted fee demarcation line, and I love that chart that you tweeted and how you have the trade-off. It's like a trade-off between the fees and how active these ETFs are. And I know you have ARC on the top right, and I believe there's quite a few on the left-hand side. Could you tell us how you came up with that line and tell us more about that?
Which line? The beta adjusted?
Yes, how you use that and how you classify. Just tell us about that structure.
Yeah, no, it just looks at active share and expense ratio. You're talking about that 45-degree angle where ARC's on the, yeah.
Yes.
That's a little of what I was saying you have to be cheap or shiny if you're active. So active share is how different you are from the benchmark. So ARC has 99% active share to the S&P, meaning it has only 1% overlap, which is basically Tesla. And so it's over here on the right, but it charges a lot. So it's up on the upper right. As you get into companies like Capital Group, DFA, they have much more traditional holdings, and their active share goes down, down, down. I think DFA's their active share might be 60%. But they charge less. So again, they have lower active share, but they also charge less, so they come down here. So a 45-degree angle shows that as your active share goes down, so has your fee has to go down because people only want to pay for the active. And I think that's fair. And because, again, beta is free. Vanguard made beta free. So you have to beta adjust your fees in the future. I would equate it to a bag of chips. If you open a bag of chips, there's a lot of air in there. And sometimes it's annoying. Like you literally open it and it's 70% air. And there's only like this much chips. People want to get charged for the chips, not the air. And that to me is what active needs to think about.
Well said. It's like you said earlier, it's a democratization. You're able to offer the consumers, the retail investors, all these massive benefits at such low fees. And that's pretty amazing stuff. Now, what I'm noticing with these active ETFs, these actively traded ETFs, is that it's more of a quant-driven approach over traditional stock picking. And I want people to understand that. It's not like they're there and they're picking stocks. It's a quant-driven approach. And they tend to use a factor-based approach over this traditional stock. Could you tell us more about that process and how the ETFs have evolved from your books that you've written?
Yeah. So, when we think about active, you usually think of somebody who's a human making discretionary picks, and that's traditional active over the last 40 years for sure. And that's where some of the rock star active managers came from. It's like they know something the rest of us don't. But over the past, I'd say there's also been a move into like quantitative investing, which essentially is like looking at evidence. Why does active outperform? Well, it turns out they were just buying like low PE stocks. Well, that's called value. Well, now that's a factor now. And momentum is a factor. Size is a factor, meaning you lean on small caps. So these quants have like found different factors, and now you can just buy an ETF that tracks those factors. And so that's a lot of what smart beta is. It takes the concept of an index, but it doesn't just track stocks by market cap. It tracks them by, I don't know, the amount of dividends they put out, or it first screens them for several fundamentals, and the ones that are left over, they get weighted by the score, and that'd be like a fundamentally weighted ETF. These are all ways to take active, but then to put it into the design of an index. Once you design it, though, you close the lid. It's like a robot, like R2-D2. But it acts in an active way. But it has discipline rebalancing, reconstitutions, and humans can't touch it. Even if the rebalance means going into some dumb stock that nobody likes, you have to let it go. But a lot of times, the rebalancing by a robot, it'll rebalance into stuff that's just really been beaten up. Like a lot of fundamental ETFs rebalanced into energy in 2021, when people were saying that like oil is over, and it would be hard for a human to do that. But these smart beta ETFs are just saying, well, these are cheap stocks. I don't really care what they do. Again, it's a robot. So it goes into these places that are harder for humans. And a lot of times you get rewarded for buying stuff that you'd almost have to hold your nose to buy. And, because the narrative in 2021 was that oil was over, clean energy was here to stay. And then bam, oil went off now it's just still going off. It's like 2.5 years running. So it's the emotionlessness plus the low fees. And then you also get the tax efficiency, which makes smart beta a compelling area and a sort of a evolution of the ETF vehicle over the years. And so smart beta now has 1.3 trillion of the 7 trillion. That's a nice little home. And if we want to call that active, we can. So I kind of think smart beta fills the gap between true passive and true active. It's sort of quasi-active, but it's powerful.
Well said. I also find it quite interesting. It's like a hybrid, and that's how I describe smart beta strategies, more like a hybrid of the passive and active, but you get the benefits of both. And I love that, how it just moves over. You don't have someone behind there. People, AI is really the future. It's so innovative. It's automated, lowers fees. It's very, technology is deflationary. And obviously, by utilizing this objective, algorithmic trading, the quant driven, they were able to keep these fees lower. I mean, you imagine how much you have to pay someone to have to sit there and actually do all this research. It's definitely helping to lower costs. Now let's talk about factor investing. I know that's a big thing nowadays. Multi-asset, global macro, trend following base. What are your thoughts on all that? Do you think that's here to stay and just going to keep growing when they combine the macro with the style?
Yeah, but there aren't that many trend following ETFs or global macro ETFs that are popular. A lot of those people use ETFs to do trend following. All trend following really is following performance. They say you shouldn't performance chase, but it's not totally true. If you can performance chase effectively, you can really make a lot of money. Because usually if something's trending up, it tends to trend up longer than you think. And so these quants try to ride it right before it goes out of vogue. So they try to like almost like piggyback off of momentum. And I think that's a very valid way to do it. It's tricky and you can get burned, but certainly I think that's a form of active that's here to stay. ETFs that do that don't have much money, mostly because most people who use ETFs, they are the trend followers. They want to do this themselves and they'll use ETFs to do it. Whereas somebody who's a big institution and they want to do trend following, that's a case where they'll probably use an actual hedge fund who's like real smart, full of PhDs. They might not use like a global macro ETF. There's a couple areas where ETFs just don't translate as well. And I think one of those is like the alternatives, although that's changing a little. There's definitely some ex-hedge fund people who are building ETFs now. We've seen some institutional flows, but largely speaking, for stuff like that, that would be more quantitative or hedge fund driven, they probably use a hedge fund themselves. But those people who do that, a lot of times they use ETFs to do it. That's, if you look at Bridgewater, they definitely use ETFs for similar purposes. So yeah, but again, we still go back to it's active, and it can be tough to do all this effectively, especially post fees. And market timing is just tough. It just anybody who's tried it knows how tough it is.
Absolutely, especially with the type of year we've had last year and this year, definitely very challenging. Now, alternatives. You said that great buzzword, and everyone's using that term all the time for we want alternatives, alternative to the 60/40, and just alternative ETFs. That have each, hedge fund ETFs, the volatility ETFs, alternative income. There's just so many ETFs out there that are called alternative. What are your thoughts on that? Do you think this is just the beginning of this trend of alternatives?
Yeah, so yeah, they've been around for a while, but there was a new rule in 4 years ago that allowed more derivatives usage in ETFs. Since then, the designs have gotten better and they've gotten more institutional caliber. So I do think there's a future for alternatives. The tough part for alternatives is that advisors sometimes don't they don't look so much at like Sharpe ratio and like volatility. They just want something that's either doing really well or is cheap. Like I said, cheap or shiny. Alts can be a little pricier, and they're not shiny. They actually are pretty like low vol. A lot of times they go long short, right? So they offset. They're trying to get something out of the market with as low volatility as possible. And I think sometimes in the ETF world that just doesn't play as well. But in the institutional world, that people love that. They love alternatives, and so I think the key for alternatives is to get so good and so high caliber, like simplifies ETFs. And there's a guy from Bridgewater who now has ETFs called Unlimited that you can
Bob.
actually sell. Bob, yeah, you can actually sell your brain and your design to institutions because they'd be like, well, normally we wouldn't use ETFs for this, but you guys are like legit hedge fund people. Fine, let's try it. Because you also get the liquidity. You can get out of Bob's fund anytime or simplifies. Hedge funds sometimes gate you, like you can't get out. And so institutions may also, between the hedge fund strategy that's legit and that liquidity, that they might be convinced to come over. But that would be my take on that. I think there's an area that will be niche versus like beta, but it has a lot of potential. Right now, alts have 10 billion. That would be like 0.2% of all ETF assets. I could see it getting to 2-3% over the next 10 years. So I could see it carving out a nice little niche. But again, even with all that optimistic growth, that's still only 2%, 3% of ETF assets.
Wow. Yes. Yeah, that's a great product over there at Unlimited. Absolutely. And are there any others that you can think about that you see a lot of growth or coming to market that have been successful in the alternative under that umbrella of alternatives?
Yeah, I mean, another one that had a lot of success was the Managed Futures ETF from Andrew Beer, DBMF. And the reason that one did really well is that sometimes these alternative ETFs put too much beta in there, which is good in up markets because they'll have a little lift to them. Whereas a true alt should have a real short position in there. His Managed Futures ETFs lean short And so in 2022, when the market, the 60 and 40 were like in the gutter, bonds and stocks both down a ton, his managed futures ETF was up like 35%. So he had his shiny object moment in the rough market, and he got a lot of flows for it. So, but I give him credit because it takes guts to put out a fund that will drag that much in an up market. A lot of times they'll stuff it full of beta so it like gets closer to the S&P, but then in a down market it sells off, and you don't really get any protection. So the more people have the guts to put out true alts, I think over time that should help.
Great points there. Absolutely. Got to be bold and come out with that properly. So DBMF, definitely one to watch over there as well. Now, talking about the inflows and outflows that we're seeing, would you say a big chunk of the flows are just like a migration from the mutual funds to these cheaper, more tax efficient ETFs?
Yeah, some of it is. Some of it's also new money. If you look at the age of a person, and then you look at surveys showing percent of their portfolio that's in ETFs, it's inversely correlated. The younger you are, the higher percentage of your portfolio is ETFs. So for like an 80-year-old, it's probably too late. You know, if they have new money, they might invest in it, but they're sitting on all these capital gains in the mutual fund. They're probably just going to like, you know, ride it out until they move and want to cash out of the whole market. So I think mutual funds will kind of retain the really, really old investors for a little while, but all the new money will go in ETFs. That said, there are still some people who are in mutual funds who are like, I can't handle this anymore. I don't like X, Y, and Z. Plus, this firm just came out with an ETF for the same strategy that's cheaper. DFA is big. They saw 30, 40 billion in outflows from their mutual funds and 30 or 40 billion dollars of inflows into their ETFs. You can't tell me some of that isn't people just wanting the better format. But like I like DFA, I just don't like this wrapper. So I do think we'll see a lot of that, people just moving over. But if you look at the flows into ETFs, they're generally far greater than the flows out of mutual funds. So there's definitely new investors coming in, and some of the outflows from mutual funds could have been somebody just cashing out. They didn't put the money into an ETF. Like I said, we can't trace this stuff perfectly, but anecdotally, that's what I would say is going on there. So yeah, over the years, the mutual fund it'll wither away, and just like vinyl and CDs and music, like they're still around, but their market share is real low. We'll see something similar over. It'll play out slowly though.
Interesting. Well, it's definitely an exciting time for ETFs, and I think it'll get more exciting. So definitely could see new money flowing in as well. Now, these asset managers, are they offering the same investment strategy just in different form? Would you say there's some cannibalization going on, that they're offering the same strategy through different wrappers that are in high demand? Are we seeing a lot of that?
You mean active managers offering the same exact strategy in an ETF?
Yes.
Yeah. Some even convert the mutual fund right into an ETF. DFA's done that. Fidelity's done it. But I think what you're asking about is what we call cloning.
Yeah.
So
are we seeing
clones,
that?
Yeah. So like T. Rowe has a blue chip ETF that's modeled off of their blue chip mutual fund. Fidelity has the Fidelity Magellan ETF. And mostly they're very similar to the parent fund, but not quite. So they're clones, but not total exact copies. Those have mixed results. Depends on what the fee is, but the ones that are more expensive haven't done well, but the ones that are cheaper have. But we're going to see people just convert mutual funds into ETFs. That's one thing. And then, yeah, we'll see more clones. But yes, all those strategies that were in an ETF will ultimately, I mean, in a mutual fund over all those years, it'll eventually make its way to the ETF. Plus more. You know, you get the legacy strategies that will move over to offer their stuff in the ETF wrapper, stuff that was used in a mutual fund for years. And then you'll have new innovation and new managers come in as well. So yeah, I would definitely say that's true. I think legacy active between bonds and stock mutual funds still has about $10 trillion in assets. And a good chunk of that's just going to move over. They'll use the same strategies, just going to do it in the ETF wrapper. And like I said, some people are just going to like the company, not the wrapper, and they'll move to the new wrapper.
Yeah, and then like you said, the low fees, the great cost migration. I love that term, but that's actually driving everything is these lower fees. I have to ask, how are they making money? If they just keep competing on lowering fees so much, are they just looking forward to like long-term growth where they could just eventually just have the market share? I mean, how are they recovering this money? It seems to be that there's less money since they're charging less. They're just more long term.
Yes, but also the market itself has gone up like fivefold over the past 20 years. So even though some of these funds have seen outflows, the stocks have gone up, so their assets have been fine. It's masked the outflows because the value of the portfolio is worth more because stocks went up. I call it the bull market subsidy. In any other business, if they lost as much customers, they'd be out of business. But a lot of these funds have been kept afloat by the bull market. Ultimately, that's why they haven't been as desperate as you think or have seen. But if the market gets flat, they're going to be in trouble, and that's when they're going to be like, "Wham! We should have lowered fees when we could have," because they'll probably get acquired. But some of them might not want to. Some of these people running these legacy mutual fund companies are 70, 80 years old, and they might be just like, "I just, you know what? Let me cash out. I'm out of here. I'm not gonna. I have no desire to compete with Vanguard in my golden years." Or do I think, I want to pass this on to anybody? Because it's brutal. Some companies, though, have been like, we want to be around. We want to have our brand around. We have to do something now. And so they've looked at the writing on the wall and they've gotten cheaper. And they've, made the decision that they have to do some form of cannibalization. But like, Steve Jobs is famous for saying, if you don't cannibalize yourself, somebody else will. And that's why in my book, Bogle Effect, I use the Steve Jobs as a powerful example that like every business happens. They put out the iPod in 2004-ish, 2005, and it was massive size, and it only held like 100 songs, and it was $600. Next one comes out, smaller, holds more songs, cheaper. Smaller, holds more songs, cheaper. And to me, that's self-cannibalization. And that's why Apple's the biggest company on earth. Like they could have easily charged more with that goodwill, or at least kept the price the same. But to give more for less over and over, you're going to people will be addicted to your stuff. And so I think some of these mutual fund companies, they don't have to do anywhere near the cannibalization Apple did, or that, just a little, and they should be all right. But like I said, sometimes it's hard to give up that money. But like I said, this is part of what I call the Bogle effect. And Bogle knew he was going to do this. Like he was like, there's going to be a lot of casualties to the index revolution. And I explore this a little bit in my book, like what will happen. And again, I get to this airline business metaphor. A lot of companies be like, you know what, I'm not doing it. State Street, BlackRock, you want to buy me? Just give me like $1 billion and all my funds are yours. So I think we will see that in the coming years, because some of them, even if they cut their fees a little, it might not be enough. So like I said, cabs were disrupted by Uber. CDs were disrupted by the MP3. It's just normal capitalism. In this case, to me, the ETF and the Vanguard effect have combined for a massive generational disruption.
Agree. Well said. I think we're undergoing several revolutions right now, like the blockchain, and everything's just innovating, and we're in a new time period. And I think that it's changing rapidly. And I have to say, your two books are amazing. You wrote them quite a while ago. I believe your first book was in 2016 or something, and you talked about how there's just so many ETFs coming out like daily, like they're just coming out, and we're still in it. And it's all, I mean, to me, I feel like it's only just beginning. So very timely there. And then the Bogle effect, I think it's an excellent book as well that you wrote about, Bogle, and 1975, I believe that was the year that he came out with that. Could you tell us more why you wrote that book? Because I know that you wanted to change the perceptions there a little bit, and you really did. Tell us about that.
Yeah, I had three reasons for writing it. One, Jack had passed away in 2019, and I was sitting on 3.5 hours of interviews with him on my dictaphone. And during the pandemic, I just it was that dictaphone was on my desk, in a little jar. And I was like, it kept kind of like calling out to me a little bit. Like I was like, oh man, I've got 3.5 hours, and I've been covering Vanguard for years, and I was just always blown away by the amount of flows they take in. They are the Amazon of this business, but they're private. So even in my research group, the person who covers asset manager stocks doesn't cover Vanguard. They only cover BlackRock and T. Rowe because they're traded. There's no reason for them to cover Vanguard, but they'd slip through the cracks even in my group. So I was like, someone should know about this company. And I've got the Bogle interviews. And when I interviewed him, I threw every question I could at him. And I thought also I want to do some research, and there'd be nothing better than to read the rest of Jack's books. There's nothing, it's like going on like some gigantic diet of only vegetables. Like there's no harm in spending a lot of time in, Planet Bogle. So I learned a lot, and I put all of that into one book. And I really just wanted to explain that as a fund analyst, every time we see something and we start to pull a thread on it, we end up back in 1975, 74 about Vanguard's decision, or his decision, to set up Vanguard up as a mutually owned company. The index fund was the second innovation, but the setting up a company where the investors own the company, that was the big thing, and nobody's copied that structure since. So even if they had no index funds, Vanguard would have been a big deal, because every time they get assets, they just all get together and they say, let's vote to lower the fees for our funds that we're invested in. So it's like, it's a self-generating fee lower over 40 years. And it's just amazing. And then you throw the index fund into that machine, and boom, you have this explosion of change. And the idea that setting a company up as mutually owned by Bogle meant that you're foregoing any real gigantic riches. You just would never get rich. Like the people who run Fidelity have like 30 billion net worth. Bogle's was 80 million. And he sacrificed the sort of Bezos billions money that an owner of a company has, because he said, I'm not the owner, the investors are. So that move was radical. And that's why no one's copied it since. There's just no economic incentive to do what he did. So I explore why he did it, the environment around it, and then the gigantic ripple effect that it's still having and will have for a long time. And in my opinion, history will be very kind to this guy. And he was also interesting in that he was very punkish. He was abrasive, and I try to capture a lot of that personality in the book. So he was also just an interesting character, in my opinion. Reminded me of my World War II grandfather. He's from that era. He's not a boomer, much more of that generation before the boomers. And but he was pretty savage, and he got in fights with his own company a lot. He would drop bombs on them because they like went in, like he didn't like smart beta, and Vanguard started launching smart beta, and he would trash Vanguard for doing it, and yet he still has an office on campus. And I just, when I first met him, I was like, man, this guy's like, he's wild. He was just very unique and somewhat of a purist, and but he essentially was one part Steve Jobs in that he created these products and kept making them cheaper and just created a whole industry using these products. But he was also half Martin Luther, the Protestant Revolution guy, in that he kind of just stuck up a new paradigm for everyone in this whole industry to like think about and deal with. And now you even have Bogleheads. I mean, they get together and talk about Bogleism, and then they argue with each other on how pure the strain is. It's just like a religion was set up. So it's fascinating, and they get chapters all over the world. And anyway, so to me, this is the biggest financial story of the 100-year period that we're sort of in the midst of, hands down. So that's why I wrote it. I was like, I can't think of a bigger topic. And also thought there was a couple books on him. They're written by older people. I'm not that I'm young, but I'm Gen X, and I wanted to write
Gen X, yeah.
I wanted to like write about Bogle through a Gen X lens too. So there's the edge, and some of the people I interviewed and stuff try to give it a little bit of a modern feel versus, the history of Vanguard. It's a little in the way it's not all chronological either, and so I tried to just mix it up a little bit as well, and try to give a slightly younger person's take on what he did.
Well, amazing piece of work, I have to say. You really put your heart and soul into that. And I have to say, the Amazon reviews as well. So many people come out and say, I didn't know this about him. Thank you so much for exposing the real side of him. And what a real humanitarian, giving back, and not just focused on the dollar, not selling out, and just amazing. The world needs to know that. And thank you to you for writing about him. Amazing piece of work, I have to say, Eric. I'm also a Gen Xer. We're young still, absolutely. So
We are.
yes, we are forever young. Another song from our time period. So I want to go into the trade-offs. There's always trade-offs with everything. And I have to say, these ETFs are too good to be true. And they just sound perfect, amazing. Like, why would anyone invest in anything else? So what are some risks? What are some drawbacks? I love the liquidity angle too. That's so important. Liquidity is so important. What are some negatives with these ETFs?
So I think two things probably are negatives. And these are the two things Bogle had a problem with. And again, with my reverence for him, I think you have to take these two things seriously. One is the trading. If you can't control yourself and you're like a person who has a gambling gene, you could argue using mutual funds might be better because it's more difficult to get out. It's not as instant, and they're not as fun, I guess. They're just like mutual fund in a 401k. Because if they do trade a lot, and if the news flow changes and you want to get out instantly, you can. So it's the trading volume that bothered Bogle. He thought people were trying to time the market too much. So if you're not controlled, they could be dangerous to you. There was a study from Germany about 10 years ago, and it left the mark on me because I bet it's true. In a portfolio, the average holding period of ETFs was 2 years. The average for mutual funds was 4. So people were holding mutual funds longer. So they were showing better discipline with mutual funds. So like I said, if you're tempted to trade, it's possible they're not the best thing to use, at least for your main account. If you only have a trading account, they're obviously great trading tools. The second thing would just be all of the new products. There's so many products being launched, and some can be confusing, complicated. You need to do due diligence. And Bogle would say, just stay with the plain vanilla ones. Don't get involved with any of the, all the newfangled versions of this and that. But he was a little more hardcore than most people. I think most general people do like to decorate their portfolio, but just be careful because they're stuffing everything and anything into ETFs now. And there's 1.2 ETFs launch every day. So over 1 ETF launches every day in the US. And there's, like I said, some of them can have some stuff going on that isn't that apparent. That's why we have a traffic light system: green, yellow, red, sort of like movie ratings. Green is like what you see is what you get. Yellow is like, yeah, there's a couple things you should know. And then red's like, hey, this thing rolls futures. They have something called roll costs. It's also leveraged. We try to just point out, hey, you're about to go see a rated R movie. Don't take a 10-year-old. And that's sort of where we think that's needed to protect people from that sort of avalanche of product. Those are the two dangers, in my opinion, for ETFs. And I think I would agree with Bogle on both of those to an extent, not as much as him. I would be as demeaning as him. He would, he really trashed some of the new ETFs that were coming out. But I would just go with that. Other than that, I mean, they're good and they've survived several crises, like March 2020, 2008, 2022 when rates went up. They've been through the ringer many occasions and they've bounced through it. Like, they're durable. And so there's nothing more than those two things that I would worry about. Like, I'd put my mom in them.
Definitely.
But if she came to me and she wanted to day trade like the VIX ETP, I'd be like, whoa, don't do that. So, like I said, there are caveats to just like, oh, they're all great.
Well said. There's a place for all of them, and discipline is key. And it's not about, you shouldn't be reacting emotionally. Try to remain objective. Obviously, we are emotional beings, and so we make our decisions in our emotions. But it's about not reacting impulsively. So well said. definitely the pitfalls of trading, and ETF being liquid, we can actually do the same thing. Now, the leverage ETFs, you mentioning the risk of higher risk ones, I would say the leverage, the 3Xs, those are ones you don't want to hold for too long. What are your thoughts on the leveraging? Are you a fan of those?
Look, I think if you're going in short term and you're purely using them to sort of like gamble, and they're for your sort of fun account, I have no problem with them. But I just don't think they should be your main focus, because they reset the leverage amount every day, which means over the medium and long term, they won't really give you 2 or 3x of the underlying. So that's why if you do use them, they're going to work better as 3x or 2x day to day. So I definitely wouldn't hold them long term. But for trading tools, they can be fun. I mean, there's definitely a wing of ETFs that tries to get your adrenaline going, and there's a market for that. To me, those would be no different than like DraftKings, like gambling on sports using leverage ETFs. To me, those are very related things, both legal, but be careful.
Well said. The gambling ETFs, SQQQ, SPXS, and all
They trade
of
a lot.
those.
They're very popular.
Very
Yeah.
popular. Exactly. Well said. Now, what I like is, people can get some options exposure with, like, let's say, the covered call ETFs. And not everyone knows how to trade options. There's a lot of different variables with time and premium and so forth. So you get the benefits of that. What are your thoughts on these covered call ETFs? I know I think they've done pretty well recently.
Yeah, they're fine. I mean, they write call options, so you give up a lot of the upside to get income, because if the index goes up a lot, the person he sold the call option to is going to exercise it, so you don't get the swing up. But a lot of, I call it, boomers are nervous. They got all this money, they're older, they'll pay for that. They'll gladly give up extreme upside for some downside protection and income. And so I call them and target outcome ETFs boomer candy. I feel like they're just really targeted older investors. If you're young, there's just no reason not to just own the S&P outright and just wait 30 years. It's the way better move. But they have appeal, and especially into 2022, if this thing JEPI is the big one. It outperformed a lot by the market. But now when the market came back, it's lagged a lot. So you have to decide how much of the upside you're willing to go. So I would just look at JEPI versus the S&P over some different time periods, and just ask yourself how comfortable you are with that. That income is not free. You kind of give up some total return to get it. There's no free lunch. So that is my take on that. But I'm fine with them, and they work. They do what they say. The products have no problem. It's just a matter of what's important to investors,
Exactly.
and how much you want to give up.
Yeah, it's always a trade-off. Always a trade-off, and there's no such thing as a free lunch. Well said. Some great economic principles there. There's an opportunity cost for everything. So I want to ask you, are we at peak ETF yet? Are there just too many coming out? You just said 1.2 a day. Are there too many ETFs, would you say? Or are we just not there for that peak ETF yet?
I don't know. I once heard that only 1% of all apps end up making money. So that means hundreds and hundreds of apps must be launched every day. This is capitalism. I'm fine with it. Most of these ETFs are not going to make, not most, but a quarter of them will probably die. That's the averages. A quarter will struggle. A quarter will make it into the middle class, and then maybe a quarter will be successful, and then 5% will be like studs. And it's going to play out like that. But you have to throw some spaghetti at the wall, and just to find something that might be the next big innovative thing that people really could use. So I'm okay with it. Some of the filings are really wacky, but I don't know. Like I said, I accept it all, that you're going to have people launch stuff, and it's just the way. This is the market we live in. Like, customers get to choose. I wouldn't
That's,
want to tell anyone what to do in terms of trying things in U.S. capital markets. Like that's the whole point of it, is that everybody should be able to try what they want to do if they have an idea. So I'm fine with it.
love it. No, that's great. Now, I know timing is everything. Sometimes they launch maybe too soon. They're trying to catch a trend and it's just too soon. The timing is off. Are you seeing any resurrections of certain, sectors, maybe ESG or anything? Is there anything that's gone out, maybe coming back?
ESG is not coming back. I just feel like it's kind of had its day. It'll remain this little fringe area, I think. I don't know. It's hard to come back once you have like a little run and you get hype and then you underperform. It's hard to get the second bite at the apple. Low volatility is something that could come back. Like low vol stocks usually have these nice runs and then like high growth works and people don't care about low vol. But a lot of times when the market comes back, people will use the low vol ETFs again. Those are evergreen because low vol, it's like, oh, I want the stock market, but like a less edgy ride. So I think low volatility ETFs should have a home going forward. Currency hedge ETFs is a big craze, but they've started outperforming again, but nobody cared the second time. It just didn't matter. So ESG, I think, is same deal. I don't think people will care if it has another run, but it underperformed in 2022. So no, some things like I said, some things I think value and growth, money piled into value, that will always happen. Those ETFs are like evergreen. But stuff like ESG and currency hedging, I think those were more fads. And those will probably not come back not even close to where they sort of peaked. People are like, oh, I did that once, I don't need to do it again. So
yes. Interesting points there. So let's I'd like to wrap up with, thank you so much for everything. You're amazing. I mean, brilliant ETF mind. I want to ask you for 2024. Okay, here we are, November 23. What are you looking forward to? Do you think there's going to be more package trades or solution-oriented strategies coming out? What are you excited about for next year?
Yeah, that's a great point. I would say that package trades, because again, people are using derivatives to do some neat things. And again, I'm fine with that. I would also look for big moves from Fidelity and Capital Group. These legacy managers, it's taken them a while, but I talked to them and they're finally have gotten the big bosses in their companies to like buy in more on ETF strategy. So I would look for some really big moves from these old guard asset managers, Capital Group, Fidelity, T. Rowe Price. I'm looking for a lot of that. And then obviously the digital assets, when the Bitcoin ETF gets approved, how far do we take that? Those are the things that I'm watching for. In fact, our big outlook theme for next year is called the many roads to ETFs. And so we're looking at, do I clone it? Do I convert my mutual fund? There's more of these tributaries now that like are able to take all this, like a lot of the legacy money will slowly find its way into ETFs. But cloning isn't for everybody. Converting isn't, they'll use different paths to get there depending on the fund and how they feel. But there's certainly now multiple roads to sort of get there outside of just saying, hey, let's start a new ETF company and launch ETFs. A lot of the legacy people are going to find these new ways to bring their customers over with them.
Very cool stuff. Very exciting times in the world of ETFs.
Never a dull moment, as I said, so it's fun to cover.
Please tell everyone how they can follow you, Eric. And I know your books are on Amazon. So just tell everyone how they can find you.
Definitely on the terminal if you have one. But if you don't, I'm on Twitter at Eric Balchunas. And I have a podcast called Trillions and a TV show called ETF IQ. All three of those things are free. So those are ways to get me for free if you don't have a terminal.
Sounds great. Well, this has been absolutely amazing and enlightening for all of us. So grateful that you spent some time with us sharing your insights. Yeah,
great to be with you. Good questions, and we covered it all, I think.
I hope so. I think we did. I think we did a good job. So thank you so much to you, Eric, and to the listeners.
All right, you got it. Talk to you later. Bye-bye.